There are 194 members in United Nations, but not every country has their own currency. Some use dollars, some use euro. So there are only 173 currency in the world. But a lot of them, they are pegged to a dollar, euro, or they are not very liquid. So for them, for all of them, there are only 30 currencies that are very available for investors to use. Not really. For example, we've seen the sterling had a spectacularly collapse because of the Brexit. And in fact, some of the biggest one-day movement in the currency markets happened in the developed market. For example, the Japanese yen, Swiss francs are always very volatile, much more than emerging market currencies. Why is that? I think because in the emerging market countries, they use the capital control and intervention to reduce the volatility. But for the developed market, the currency market is so big, much bigger than the balance sheet capacity of the central bank. We mainly use derivatives because we don't touch the underlying stock or fixed income asset. That's also what we call the overlay management. Derivatives include currency forwards, swaps, options. In order to have a better management, we tend to choose short maturity so that whenever we arrive in maturity, we roll over to a new uh, maturity. There are different ways. For example, today, because in the traditional asset class, the return potential is quite poor, so people can use currency as a way to generate alpha. And the second way is that because liquidity is become a key issue for many markets, so investor can use currency as a way to change the asset allocation in the most efficient way without paying a lot of liquidity premium. Another way is that because we are in a very low yield environment, investors would not like to sacrifice their precious, very low performance just because of the currency fluctuation. So they can use currency hedging to optimize the currency exposure. I think fully hedge or no hedge is not good. We should consider managing the hedge ratio. Some of the currency is good to keep in the portfolio instead of hedging them away, as long as they can act as a shock absorber for the underlying assets. For example, it's always good to have some US dollar or Japanese yen in a portfolio. And then to hedge back to sterling is also a question of timing. Obviously, if we hedge back to sterling over the past few months, it won't be a good choice. After the sharp depreciation of the sterling, it is now undervalued. However, history suggests that a currency can stay undervalued for a while before recovering back towards the fair value. Having said that, currency is a relative concept. So from here, where the sterling will go is not just a function of where the UK economy will be, but it also depends on where the dollar and euro will go. Well, it will be very exciting for investors because the volatility creates a lot of opportunities for us to generate alpha. But for the investor who have already a lot of overseas investments, I think they should start to consider managing the currency risk. Our company Amundi has been managing currencies for more than 20 years. over the past 10 years, we have been working quite hard for different institutional investors to provide them a lot of advice on how to manage currency, how to do currency overlay. So if you have any questions, we are very happy to sit down and discuss with you, and that we can help you.